Globally, 2015 will be the 5th consecutive year of underperformance for mining shares relative to the broader equity market. And in the case of South Africa, it will be the 6th consecutive year. That is not quite unprecedented in terms of the history of the mining industry, but it's getting damn close. As we all know, commodity prices have collapsed from their highs, and there appears, I would say, to be little optimism that we are about to see any sustained rebound in the short term. And then the mining industry itself, which entered the super cycle with its balance sheet completely intact, and then managed for various reasons to enter the downturn with its balance sheet in anything but an intact condition. In fact, it was extremely stretched, and the industry is now having to deal with that situation, as we've most recently seen in the case of Glencore. So that makes for a fairly potent cocktail, and it's against that, I say, most propitious of backdrops that we hold this discussion. Let me start out just with the whole issue of commodity prices, because after all, those are it's commodity prices that underpin earnings. We've had the stronger for longer thesis. We now almost appear to be in the what I would call the weaker forever phase.
We've had China come into the market in the last decade, which I think is a one-off event. Now, China's growth pattern is nothing unusual about it. It's marked by an emerging market. But it's just big, and it's the biggest story ever, and it's happened now. And that's behind us to a large extent. And so that thing won't be repeated. But having had this huge boom as a result of China, one would expect that the downturn would be longer rather than shorter. The people in the top of the companies actually have very little knowledge about how to allocate capital because of where they come from and their experience. And they're great guys, and they have a lot of, they're very important to the whole industry, but they just have a tendency to not be good at capital allocation. Bankers and sell them ideas and take over X, Y, and Z and so on. And the industry lacks people at the top who really have capital allocation, good capital allocation experience and knowledge.
Many company executives have done what they were incentivized to do. At the head of these companies sit strong operational people, geologists, metallurgists, and these very highly skilled mining people. So the top of these companies, and they are soft targets for investment bankers and fund managers. And the reason they're soft targets is because they are incentivized through a share price mechanism and not through operational metrics, not unit cost or life of mine or those sort of operational metrics. They're incentivized to get the share price up in the shortest amount of time. Fund managers are incentivized on quarterly returns, so they need to get the share price up in the shortest period of time. Not all fund managers, of course, but many. And investment bankers just want to do a deal. So these operational people are sitting there, and they are being used by the capital, the feeders on the capital system. And that's where I think the boards should come in and be able to guide the management in terms of capital allocation. That does not happen. You have rubber stamping boards that just approve every deal because deals are sexy. Let's face it, it's fun to do a deal. You're in the newspaper and there's all sorts of noise and headlines and stuff going on, so it's fun to do a deal. And the board just say, well done, let's buy X and Y, and then we're bigger, share price goes up and our options kick in, and we make a lot of money, and the fund managers make a lot of money, and everybody's happy. And at the end of the day, if you look through this super cycle and this fall back of whatever, how the cycle works, the only people who have made money out of it, or the only people who haven't made money out of it, are the shareholders.
When we engaged with some of the CEOs, they were investing in things that when you ask them what long-term price have you used, they didn't have a clue. And it was absolutely stunning to see the kind of money that was being shelled out by CEOs who couldn't defend the basis of those investments. There was a lot of money lost buying things at the top of the cycle. We engaged with those, and they were very defensive, and in most cases, of course, it ended up with us parting ways.